Hello, thank you for joining this talk about the BSc in Actuarial Science at the University of Kent. This talk was originally going to be given as part of the applicant day on Saturday the 21st of March, but recent events have meant that I'm giving this talk remotely. This talk will last about 45 minutes. For about half an hour I'll talk about the BSc programme at the University of Kent, and then for 15 minutes I'll give an example of a tutorial which gives you an idea of the way in which we deliver material here and gives you an idea about one of the subjects that we might cover within the programme. Separately to this talk, my colleague Ian Rogers is giving a brief talk on employability within the School of Mathematics, Statistics and Actuarial Science at the University of Kent, and he'll also talk about the Year in Industry option that is available as part of the programme. As well as that, there will be an opportunity to join me online for a question and answer session on the Saturday. Okay, who am I? Well, my name's John Millett. I am a reader in Actuarial Science here at the university, and I've been here since 2002. I'm a qualified actuary, qualifying as a fellow of the Institute and Faculty of Actuaries in 1993. I originally studied maths at Nottingham University. This was at a time when actuarial degree programmes were not really around, so my qualification process involved distance learning and studying during the evening whilst holding down an actuarial job. For most of my career prior to the university, I worked in the life assurance industry, primarily for various parts of Lloyds Bank, including working in life assurance product development, in company business planning, and in group risk. Since I've been at the university, I've lectured in many of the different subjects that we cover here, and as well as doing that, I am actually the Chief Examiner for the Institute and Faculty of Actuaries, and I lead a team of 5 other examiners and about 40 markers who examine the actuarial mathematics subject, which is part of the qualification process of the Institute and Faculty. In terms of my talk, I will start by talking about what the typical areas that actuaries get involved in, and then I will talk more specifically about the programme. In particular, I will talk about how one becomes a qualified actuary and how the course here at Kent will enable you to start on that process. And towards the end, we'll also talk about what other elements that Kent offer you should you come and study here. So what do actuaries do? And in many ways, this is a very difficult question to answer. I always find it quite difficult at parties to say, what is it you actually do? But on the slide, we try and give an official type answer, which is really to say that we use our mathematical, statistical, economic skills and our analytical skills to try and work out what's going to happen in the future, taking into account that some events are uncertain, and we'll use those to solve the business problems of companies, governments, and individuals. And as part of that, what we're trying to do is look in terms of uncertain events in the future and see what risks that maybe particular businesses face. So what could go wrong? And if something did go wrong, what could it cost? And if we know that, then maybe we have some knowledge about how we can minimise the probability of things going wrong in the future. Or if they did go wrong, how can we minimise the costs should that occur? So really what actuaries are doing is they're looking at their knowledge of what's happened in the past and applying mathematical and statistical techniques to project those into the future, to estimate what's going to happen in the future, but making allowances for the fact that circumstances change. For instance, what might happen if suddenly a pandemic affects the country or the globe. So more specifically, the types of questions that actuaries may answer. And there are three examples on the slide here, and the first two are very much traditional areas that actuaries have got involved in. So an actuary working in life assurance would be working out what would be a fair premium for companies to charge for their products. So if someone takes out life assurance that will pay a benefit of £100,000 should the policyholder die within the next 25 years, what would be the fair monthly premium for that? And how would we calculate that? And equally, should that policy go into force and we have the policyholder paying premiums, what money should the company hold in order to ensure that it can pay any claims as they fall due? Now, when we're calculating that premium, we need to think about what is the probability of a claim. What is the probability that the policyholder will die during the term? But we also need to make allowance for the fact of what are the expenses that the company will incur in selling and maintaining the policy. What rate of interest will be earned on the premiums and the money that the company holds? And we'd probably want to make some allowance in many circumstances for the company actually making a profit from its business. Another example is that many companies will operate a pension scheme for their staff as part of the remuneration package for the staff. And if someone joins a company at 18 and then retires at age 60 or 65, then money will be paid into the pension scheme over a period of over 40 years. And then at the end, when the staff member retires, a pension will be paid for the rest of their life. So we need to work out how much money needs to be paid into the scheme, maybe by the staff member themselves, but also by the company, in order to cover these future payments. And that requires estimates on a very long-term basis, again about the interest rates that might be earned on money over that period, also about the probabilities of the staff member surviving till retirement and how long they will survive until after retirement, and also other elements such as allowing for the expenses of running the scheme. An example of a more recent area that actuaries have got involved in is looking more generally at what we call enterprise risk management. And this is looking at the various risks that companies face when undertaking their operations. So this might be, for example, what happens if a product issued by a company goes wrong? What happens if events occur that mean that the company can't sell its products? What happens if the company ceases to operate properly? It may be that then, for example, there may be fraud within the company. We've got all range of risks that a company faces on its day-to-day basis, and most of those will carry some financial consequences. How do we manage those financial risks, and how can the company protect itself against those risks? Again, how can it minimize them occurring, and how can it minimize the financial impact? So where do actuaries work? Historically, the traditional areas that actuaries have worked have been in life assurance and general insurance companies, working for pension schemes, working for actuarial consultancies. Actuarial consultancies are companies made up of actuaries who will actually advise other insurance companies, other pension schemes, other companies that don't have enough actuarial expertise themselves. And that's a very popular area of actuarial work. Also, actuaries will tend to work in the investment area and in the stock market. And some actuaries actually work for government. In the UK, they might work for the government actuaries department, which amongst other tasks will be involved in the funding of the state pension scheme. Some actuaries will work for banks and other financial institutions, and even actuaries such as myself who work in education and at universities. An often quoted benefit of becoming an actuary are the financial benefits. And I think the slide here, which comes from the Institute and Faculty of Actuaries' own website, and the web link is at the bottom of the page there, gives you an idea of what actuaries can earn at various levels in their career. Now, you're not just necessarily going to be thinking about salary. You'll probably be thinking about wider issues in terms of job satisfaction, enjoying the job, and so forth. But you can see from here that the ideas about high remuneration definitely have some element of truth behind them. One recent survey about different jobs, which was actually carried out by an American careers company, CareerCast, showed that in 2019, an actuary was the 10th best job in the survey out of over 200 jobs. And that didn't just cover salaries, it covered other elements: work environment, stress levels, the projected growth within the industry. How likely was it that actuaries are going to be needed in the future? And actually scored very highly. And it goes to show that it isn't just about the money. If you are interested in solving mathematical problems and using your analytical abilities, it can be a very enjoyable role. So don't just think about the money. So that's a brief description of actuarial work. And if you dial into the talk later on, then I can potentially answer more questions about that. I'm now going to go on to how you become an actuary and then fit that in terms of how the BSc in Actuarial Science actually fits into this qualification process. To become a fellow of the Institute and Faculty of Actuaries, you need to pass 13 exams. Now, typically, if you weren't doing an actuarial degree course, this would take probably 5, 6, 7 years at least to actually go through the process. And clearly it's therefore an advantage if you can cover the early subjects via your degree program. So not only do you get a degree, you get a fast start in your professional qualification process. The Institute and Faculty of Actuaries, whose qualification structure we're going to go through, is the UK actuarial body. And they recently changed their examination structure. They changed it from 2019, so that instead of all exams being generally assessed via a traditional examination and exam hall, some subjects actually have an element of what is called problem-based assessment. And the first 4 subjects on this slide, CS1, CS2, which are the 2 statistical subjects, and CM1 and CM2, the actuarial mathematical subjects, have this element of problem-based assessment. So in CS1 and CS2, not only would you do a traditional closed book exam, but you would have some assessment using the statistical software package R, which is a free package to download. You can download that easily, and is very much used not only in university statistics departments, but more and more in statistical work in business. And CM1, CM2, the actuarial mathematics subjects, will also involve assessment via Microsoft Excel. If you were given an actuarial mathematical problem to solve in work, you wouldn't go into an exam room and try and sit down without any reference to your notes or any reference to any books and try and solve it that way. What you would actually do is you would probably use something like a spreadsheet package to actually solve the problem. And the idea that these subjects now involve assessment in R and Excel is to try and give you an idea about how you would actually solve problems in the real world. As you can see, there are 7 subjects on there, and you would need to complete those as part of the first element of the qualification process. After that, the next stage are the core practice subjects, CP1, CP2 and CP3. Now, whereas the subjects on the previous page were largely mathematical, so if you did an exam question in one of those subjects, it might involve a question that was of a similar style to perhaps something you would cover in an A-level maths paper. The CP1 actuarial practice subject is more discursive, it's more wordy. It's not so much actually using mathematical techniques. It's explaining why you might use them in certain circumstances, the factors that you would need to take into consideration, and some element of considering the practical environment when you're trying to solve these problems. Now, don't get too worried in terms of the fact that it is more wordy. Many of you may not be fans of writing long essays. I know I certainly wasn't. And it's not a case of writing paragraphs and paragraphs of dense prose. It really is when you're studying for those exams and taking those exams that you're actually trying to write short, sharp, concise points to explain how to answer a particular question. CP2, the modelling practice, again, is an Excel-based subject, which involves actually the importance of documenting models and creating audit trails so that other people can actually follow the work that you've done. And CP3 is communications practice. It's not just in the 21st century enough to be a very technically competent actuary. You've got to be able to communicate with others at all levels, whether it be board members of a large company, whether it be with a layman, whether it be with a policyholder who has limited financial knowledge. So therefore, it's very important to be able to communicate in terms that other people can understand. And as part of communications practice, you might do an exam, but you might also undertake a presentation and demonstrating your presentation skills after hopefully a degree of practice. Again, those 3 subjects are compulsory, and then after that you get into the optional part of the qualification process. You would take 2 subjects from a choice of 8 specialist principal exams. These subjects would involve options in life assurance, pensions, general insurance, finance and investment, derivatives and finance, enterprise risk management, and health and care. And then from those subjects, you would choose one of those to carry on to the final specialist advanced level to complete the examination requirements to becoming a fellow. So I've talked about the qualification process. How does that fit into our BSc in Actuarial Science program? Well, on the slide there, you can see 6 subjects that are in pink. And those are the subjects that are actually covered within our BSc in Actuarial Science. And if you do well in your degree, then you can get exemptions from those exams. And that means that out of 13 subjects, you will have already covered 6 of them. If you actually carried on and did our MSc in Applied Actuarial Science, you could get exemptions from the 3 core practice exams, as well as 2 of the specialist technical exams, which would mean that you would only need CV3, the business management subject, and the final specialist advanced subject in order to complete your qualification process. So, in particular about our BSc courses, there are some options within them. The standard option is to do the 3-year BSc program, which will cover the material in 3 years. For those of you who haven't got necessarily the entry requirements to be accepted onto the 3-year program, there is a foundation year option, which enables you to do that foundation year at the start before following on with the 3-year program. And that's an option as well. And both of those programs, whether you do the 4-year option or the 3-year option, have a year in industry option where you can actually go out and take a role in an actuarial related job, and that would normally take place immediately prior to your final year of study. And in the employment talk, there will be more details about that year in industry, and also I can actually answer some questions in the question and answer session as well. For background, we also run postgraduate programs as an MSc in Actuarial Science, which is really designed for people who've done a BSc, for example, in a mathematics, economics or statistics-based subject but doesn't have any specific actuarial background, and they would cover the material that's covered in the BSc in Actuarial Science in a year. And then there's also the MSc in Applied Actuarial Science, which, as I've said previously, covers the later subjects. So, what is covered in the various years of the BSc in Actuarial Science? If you undertake the foundation year, then you will cover some core mathematical subjects and some core statistics subjects, and also subjects in specific mathematical areas such as vectors and mechanics and graphs, geometry and trigonometry. And there's also an option to take a module that isn't directly related to maths or actuarial science, but might give you a more rounded background and a greater, a broader element of education. And you would need, if you undertook the foundation year, to actually pass that year in order to be able to progress to the remaining 3 years. And then, if you go to the first year of the 3-year programme, which we call Stage 1, then you would cover the 8 modules listed on the slide there. I should say at this stage that Kent generally operates with the idea that each year you will cover modules that count for 120 credits. You need to get 120 credits to complete a particular year. And typically, Kent will have modules that are 15 credits in size each. Therefore, you would do 8 modules of 15 credits each. There are some modules that are double modules, and they work in a similar way. And as an idea, if you were doing a 15 credit module, that would involve classes of 3 to 4 hours a week over one term of 12 weeks. So typically, a module will involve 36 hours to 48 hours of contact time over one term of 12 weeks. And you've got the 8 modules there. You've got 3 in mathematics at the top there. And then the bottom 5 on that slide, the probability, the statistics, the financial mathematics, the business economics, and the actuarial practice 1, they start to cover the actuarial material that is part of the Institute and Faculty of Actuaries qualification process. And your ability to get exemptions would be specifically related to your performance on those bottom 5 modules. Having completed stage 1, you then go on to stage 2. Again, there are 8 modules there, and the top 6 modules there, the mathematical statistics, the statistics for insurance, the applied statistical modelling, the actuarial mathematics 1, the corporate finance, the financial reports and their analysis. Again, they are covering the subjects of the Institute and Faculty of Actuaries, and again, your ability to get exemptions would be based on those 6 modules. And then you've got 2 further mathematics modules in optimization and linear partial differential equations that make up the year. Then finally, in stage 3, you have got the modules listed there, and all of those relate by and large to the material of the Institute and Faculty of Actuaries subjects. One module that is worthy of pointing out there is the financial modelling module. Within that, you would get access to the actuarial software Profit, which is a market-leading actuarial software that covers a lot of the modelling requirements that are used by life insurance companies and general insurance companies worldwide. So this gives you an idea of what people would actually do in the real world, again, than rather just thinking about theory. The financial modelling module will also cover some financial modelling in Excel as well. So it's a practical module, and whilst it doesn't cover material of the Institute and Faculty of Actuaries directly, it is a good practical background and is a way of showing you how the theory is actually used in practice. Also there, you've got a brief description of the year in industry, which as I said is taken between stage 2 and stage 3, where stage 3 is the final year. Okay, so what is it about Kent that might make you want to come to us? Well, we have 12 qualified actuaries on staff. We have a wide range of professional experience. You saw from my background that I worked for about 15 years in the industry before coming to Kent. And a lot of the people who are here at Kent have similar backgrounds as well. This means that we're not only just going to teach you the theory, we're not just going to teach you the techniques, we're going to explain how these are used in the real world. We're going to give you a practical dimension to the use of those techniques. Sometimes we might say, yes, this is in the syllabus, yes, we need to teach you this, but in practice we don't use it a lot. Or alternatively, I might say, this, when I was working and designing products in life assurance, I would be using these techniques pretty much every day, and it's absolutely key that you understand them. So we like to think that not only are we giving you the technical skills, we're giving you practical skills as well. The University of Kent, as you have probably inferred from the various programs that we offer a wide range of exemptions. I believe that we offer probably the widest range of exemptions across the subjects from any UK university. So you have the ability, for instance, if you did the BSc and then carried on with the MSc, to get exemptions from 11 of the 13 subjects within the qualification process. And finally on this slide, I'd like to emphasise the fact that we put a great emphasis both within the programme and the school, and in fact also throughout the university in terms of employability. There are actuarial practice modules in stage 1 and in stage 3, which involve learning again about the practical elements of the various areas in which actuaries work. Looking at employability, you'd be given background in supporting drafting a good CV in order to be able to apply for a job. There's a great emphasis on computing skills and software skills. So you will do courses in Excel, you'll do courses in the statistical software package R. You'll do a module that involves working with Profit, the leading actuarial industry software. And as we've said, we've got actuaries on staff who have got a huge background in the industry and have strong links with employers and within the actuarial industry itself. Are there any questions? You may wish to pause now. In a minute, I will go on to an example tutorial where explains one of the topics that we might cover at the early stages of stage 1 of the programme. Please don't feel obliged to continue to look at that. You might find it interesting, but if you don't want to, that's fine. And equally, it's not something we're going to test you on, so don't worry that I'm going to ask you in the question and answer session about the tutorial. This is just for your information and to hopefully just give you a bit of further background. Okay. So in terms of the tutorial, let's just think again about the kind of problems that actuaries get involved in. So we've got some examples on here. We're trying to use our actuarial skills. We're trying to use mathematical techniques in order to estimate the financial implications of future uncertain events. And that will enable the businesses, or indeed other organisations, to make informed financial decisions. So the first example on there is, should a car company release a new model? Now, in reality, if a company is going to release such a model, it's going to involve many years of design and development and testing. And it, as I say, it may be many years from the original idea until the model comes on market. So you need to make quite informed estimates about how the costs are going to be incurred over the time of development and how they're going to be recouped in terms of increased sales once the model has actually been put onto market. Second problem could be, who should a bank lend money to? Clearly, if you lend money, one of the key elements is, will you get that money back? What are the risks of the borrower defaulting on the loan, not paying the loan back? And how should you allow for that? typically what lenders will do is that they will charge a higher interest rate, and the interest rate is basically the cost of borrowing money, to more risky borrowers. And the more risky you are, the higher the interest rate you'll have to pay in order to borrow money. How do we estimate that? How do we work that out? And that's one of those elements that we might want to get involved in. Third issue is, should an insurance company sell car insurance to under 21s? Historical evidence suggests that under 21 drivers get involved in more accidents, make more claims. I'm sure many of you are aware that the cost of obtaining insurance at a young age is often prohibitively expensive. How should insurance companies price that? Do they directly allow for the likely higher cost of claims? What can they do to mitigate against such a higher cost of claims? For example, you could put in some safety devices into the cars of recently qualified drivers. Should you take into account that basically today's under 21s will be the older drivers of the future? Should you make some allowance for the fact that you want to develop a long-term relationship with a young driver in the hope that they're actually going to give you their business over the rest of their lifetime? And it might not be their car insurance, it might be house insurance, contents insurance, travel insurance, and so on. And finally, how much tax should the government impose on cigarettes? Governments have historically reckoned that cigarette smokers are relatively impervious to increase in the cost of cigarettes, and have therefore typically every year put up the tax on cigarettes, with the feeling that that will lead to an increased intake. Will that carry on forever? It may well be that once the tax becomes too much and people become more informed about the health implications, that fewer and fewer people will smoke. And indeed, the statistics suggest that fewer people smoke than did 10, 20 years ago. Therefore, how would that impinge on government tax policy? Okay, so let's look at a specific example. We're going to say your mobile phone has just died, or maybe you just fancy the latest model of phone, and you want to decide how you're going to pay for it. And we'll assume that you've made the decision about which network you're going to go with, and which model you want, and the length of contract. And we're going to assume that you're going to go to one for a 12-month contract. And you've narrowed it down to the 4 deals that are on the slide there. Now, I'm going to go through this probably at a faster pace than if I was talking to you face to face. So please feel free at any time to pause and think about the questions that are actually on the slide here. And the questions we've got here are, firstly, what is the total outlay under each of the contracts? And I'm hoping that that's a fairly straightforward question for you to answer. But the second question is probably more deep. What should you take into consideration rather than just the total outlay? Are there any other factors? And if you think about that, and the design of the 4 options may give you some hints, then we'll carry on looking at them. So, in terms of the total outlay under each contract, I think it's fairly clear how we've got to those numbers there. And we can actually see that the answers for the 4 options are all fairly close to each other. In reality, in terms of pure numbers, option 4 is the cheapest, followed by option 1, and then option 2 and option 3 together. Is that the best option? And as the question suggests, that might not necessarily be the case, because option 4 involves a very high initial outlay at the beginning of the year, which means you can't use the money for anything else, and you can't earn any interest on the money. And we're therefore going to look at the concept of the time value of money, the idea that if you hold the money now, you can invest that and hopefully earn more in the future. rather than just spending it all now. So let's look at a particular example. And we're going to make a couple of assumptions here. We're going to assume that you start with £1,000. And we're going to assume that if you've got that in a bank account, that account will earn interest of around 0.5% a month. And the question we're going to ask is, how much money would you have left at the end of the year under each option? With the idea that the option that gives you the most money left at the end of the year would be the best option. So, I've got the slide on deal 1 here. Now, I have solved this via a spreadsheet. In fact, when you come to look at our financial mathematics course, we'll show that this can actually be solved via an equation approach as well. We can actually solve it analytically. But in reality, if I was going to solve this problem in real life, I would actually solve it via a spreadsheet. It's a much more flexible method. And in many ways, it's a clearer sort of demonstration about how the finances are actually working. So I've got a table here, and we're starting with £1,000. We note under deal 1 that the cash out at the start, the cost of the phone is £110, and we're also allowing for £35 going out at the end of each month. Now, remembering that we've got a bank account earning 0.5% of interest, we will see that if we take the £110 out of the bank account, we're left with £890, and that £890 will earn 0.5% interest in the first month, which will work out to being £4.45, 0.5% of 890. So then, at the end of the month, we have the £890 plus the £4.45 in interest, less the £35 that we're paying out as part of the monthly contract, so that at the end of the month, we have £859.45. And then, if we've got £859.45 at the end of the first month, we can treat that as the figure at the beginning of the second month. And then we can repeat the process that we did in month 1, only there's no further cash out at the beginning of month 2. So we still have £859.45. The interest on £859.45 will be 0.5% of that, which works out to be £4.30. And at the end of month 2, we therefore have £859.45 plus £4.30 less £35, which is £828.75. And we can carry on like that in month 3, all the way through to month 12. And at the end of the year, we find that the money left in the account is £513.15. And we can repeat that process for deals 2, 3 and 4. And on the next slide, and unless you've got a big screen, you might not be able to see all the numbers here. We can see the results at the end of year 2, 3 and 4. And you can see, again, that deal 4 leaves the most money in the account just from deal 1, and then deal 3, and then deal 2. So if we just do a summary of those final numbers, we see that deal 4 again is the best, but only fraction from deal 1, almost so much that you might regard those two options as being pretty much interchangeable. And then you've got deal 2 and deal 3. But we've clearly made some assumptions there. We've started with £1,000. We've assumed 0.5% per month interest rate. What happens if we change the interest rate? The question there says, think about it without doing any calculations. And I'll let you pause for a second there. Please pause if you want to think about it. And I'll carry on now. And if I was thinking about the question, I'd think, well, if the interest rate is 5% per month, it's clearly more attractive for me to hold my money in the bank account. Therefore, I'd want to keep the money in the bank account as long as possible. That means that deal 4, where I spend £400 straight away, looks less attractive, and deal 2, and in particular deal 3, start to look more attractive. So you might think that deal 3 could well be the most attractive one. And we'll look at the actual numbers on the next slide. The other question on this slide says, what happens if you only have £390 in your bank account? Well, that means that in theory, deal 4 is no longer available because you haven't got the money to actually pay the £400 unless you can borrow or take an overdraft or maybe negotiate a discount. So let's look at what happens if the interest rate changes. In that situation, we find that if we had 5% per month being earned in the bank, that deal 4 is suddenly the worst by a considerable margin, and deal 3 is the most attractive. In a way, deals 1, 2, and 3 are not that different, and I'm looking at the 5%, the right-hand column here, but deal 4 definitely looks less attractive. And indeed, if you look at only earning 1% per month in the bank account, deal 4 is still the least attractive now, though by a lower margin. Now, as I've said, that gives you an idea about what we're thinking about. And what we've been looking at is the time value of money, saying, if I have a choice between being given a sum of money now or a sum of money in a year's time, then if those sums were equal, I'd rather have the sum of money now because I could invest it, hopefully earn a positive interest rate. Now, following the further interest rate cuts yesterday, you probably wouldn't earn a very high interest rate, but you would still normally earn a positive interest rate. So you would normally prefer to receive money earlier, and we need to take into account that difference between receiving money now and receiving money later. And I've said we've solved this using a spreadsheet approach, but we can actually also solve it analytically. We can solve it via an equation approach. And those are the sorts of problems that we would look at in our financial mathematics module in stage 1. So, in terms of answering the question, which deal offers the best value of money, the answer is it depends on our assumptions. How much money did we start with? What interest rate can we earn? And indeed, what else could you do with the money? You might have some pressing urge to spend the money on something else, maybe something more of a necessity. So in reality, there are lots of factors you're going to need to take into consideration. And many times, the answer to a problem is going to be, yes, it depends. There's not automatically going to be one correct answer every time. And that is the kind of elements that we need to think about when we're considering actuarial problems. As I've said, what we've been talking about is the time value of money, recognizing that it's not only the amounts of the payments, it's the timing of the payments. We've considered a mobile phone example, but if we think about the business scenarios that we discussed earlier, a lot of these elements involve a lot of factors. And the box in red there says, what happens if we think about the likelihood that payments will happen? In our previous example on the mobile phone, we assumed that all those payments were definitely going to take place. In reality, when we're considering future events, we've got to take into account the fact that those events may or may not happen. Should a car company release a new model, do we need to take into account the fact that in certain circumstances the model may not be released? Do we need to take into account that the number of sales of that model will be a variable amount? If we're looking at a bank lending money, do we need to take into account, and the answer is yes, the probability that that money won't be paid back? If an insurance company is going to sell car insurance to under 21s, what are the probabilities of claim going to be? And if there is a claim, what is the size of that claim? Those are unknown amounts. How much tax should the government impose on cigarettes? Again, yes, we need to think about what happens if we put the tax up and people stop smoking. We probably generally regard that as a good thing from a society and a health point of view, but it does have implication on government revenues. So when we're thinking about actuarial work, often we're thinking about the time value of money, but we're also thinking about the probabilities of future events taking place. Again, I'd normally ask for questions here. This is the end of the talk. If you're able to attend the question and answer session, I'm quite happy to answer questions on anything I've discussed, or indeed anything to do with the program. Thank you very much for watching this talk. I look forward to speaking to you at the question and answer session. Thank you.